So let's start with a number. 13.3%. Now, this isn't just some random figure pulled out of thin air. This is the record high incentive rate that America's second largest home builder, Lennar, is now spending just to sell a house.
I mean, that is a staggering tenfold increase from the peak of the pandemic boom. It's the highest level they've spent since 2009. To put that in perspective, on a typical $450,000 home, that's about 60 grand in incentives. That tells you the market has fundamentally, dramatically shifted.
And look, this isn't just a corporate issue happening on a balance sheet somewhere. As Wall Street vet Jordi Vister points out, the median person is really feeling the pain. I mean, with housing affordability at a 40-year low, just the essentials feel impossibly expensive for so many people.
Okay, so while that traditional system is clearly under a lot of strain, another one is having a moment of absolutely explosive growth. The headlines right now are being dominated by the rise of this parallel digital asset economy.
And we're not talking about some niche thing on the fringes here. This is being led by corporate giants. We're seeing major players making serious moves into stablecoins. Digital currencies that are pegged to a stable asset like the US dollar. Walmart, for example, is reportedly looking at launching its own.
And guess what? Amazon is said to be doing the exact same thing.
Of course, the financial behemoths aren't just sitting on the sidelines. JPM, they've already announced JPMD, which is their own alternative.
And then you've got Stripe, partnering with Shopify to let businesses across 34 countries start accepting stablecoin payments. That's huge.
Honestly, the list just goes on, from Coinbase to Peter Thiel's Founders Fund. This is a mainstream tsunami of adoption. The key takeaway here is crystal clear. While the old system is struggling, all this serious capital and incredible innovation is flooding into this new one.
So with all of this happening, you just knew that Washington would have to wake up and start paying attention, right?
And, former Chairman Patrick McHenry just nails it. He says crypto has crossed the Rubicon. Lawmakers, he says, are followers, and right now they are following the will of the people and the sheer momentum of this market.
And this shift has been incredibly rapid. The whole narrative has flipped from constraint to encouragement. We're even hearing the Treasury Secretary now say that stablecoins could reinforce dollar supremacy. It's wild. By the way, if you want to keep up with these fast-moving policy changes, you should follow us on Twitter @SnippetLabs for more updates.
Okay, so this is a lot to take in. How in the world do you make sense of all of it? Well, let's transition from the what to the how. Raoul Pal's Real Vision offers a really powerful framework to do just that, and it comes from their chief crypto analyst, Jamie Coutts.
So Coutts' analysis really starts with this key concept, global liquidity. Just think of it as the total amount of capital flowing through the financial system. It's basically the fuel for all asset prices. And what he's found is that Bitcoin has this very unique and powerful relationship with this fuel. And this is where it gets really interesting. Check this out. Normally, a 1% rise in global liquidity leads to about a 7% rise in Bitcoin's price, okay? But in what he calls breakout regimes, which is exactly where we are right now, that sensitivity just explodes. It jumps to 20 or even 30%.
So he takes that powerful insight and combines it into this really comprehensive three-part risk model. It analyzes liquidity, leverage, and the on-chain health of the network itself.
So the big question is, what is this sophisticated, data-driven model telling us right now? It's flashing super neutral. And what that suggests is that despite all the recent price moves, the market is not over-leveraged, it's not overheated, and it's not disconnected from the fundamentals. Hey, if you're finding this valuable, do me a favor and drop a like and share.
And that brings us to our final and maybe most crucial point. How do we actually use a framework like this to navigate the absolute chaos of daily headlines? For that, we're going to spotlight a take from macro strategist Darius Dale.
I mean, you know how it is, right? Every single day, we are just bombarded with these terrifying headlines about geopolitical conflict, and it feels like you have to react.
But Darius Dale gives us the antidote. He advises against those knee-jerk reactions, arguing that these events almost never reward panic selling. Unless your own systematic risk model is signaling a major change, the best strategy is to hold firm. For more deep dives just like this, make sure you subscribe to the Snippet Labs YouTube channel.
And this really just highlights the two completely different paths an investor can take. You can be headline-driven, reacting to fear, emotional, focused on the short term, or you can be framework-driven, systematic, disciplined, with a long-term view. The whole point is that having a system is what allows you to separate the signal from all that noise. Which leaves us with a final question to chew on. As the old financial world is showing all these cracks, and this new one is rising up in the middle of so much global uncertainty, maybe the most valuable asset you can own isn't an asset at all. Maybe, just maybe, it's a clear framework for making decisions. Markets move fast. Pinpoint your next profit window and seize the moment.